Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, it's time to follow the big money. Are they exiting the market? Well, we're going to show you what to look for in this video. Let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you have not joined our service yet, come check us out, tradelikeagenius.com. Full service. We have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening.
So Bob, as the market goes up, there's a certain thing that the big boys tend to do, especially as if it precedes a recession, and that is they start eyeballing and sizing up that bond market. So what alpha do you have for us today?
So we're not changing any of our macro view. We're still looking for the summer of fun for the stock market, but the big money just can't decide on August 15th they want to exit the market. So what they've been doing is they've been slowly, like an elephant tiptoeing here through the garden, is that they've been slowly raising the duration of the bonds that they own and are accumulating these bonds for the inevitable recession that's coming. And you can see it here in the in this chart here. It's called a duration bet. And so when you trade in bonds, there's two ways to make money, Phil. One, obviously you're going to get clip the coupon and get the interest. The other one is capital gains. And that is the area where you can make a lot of money really fast. And so when you looked at what happened in 2000, 2002, 2007 into 2009, as the markets are going down 40 or 50%, the long bonds are going up 40 and 50%. So there's no reason why we can't participate in that upside. And I did in 2008. So we want to be mindful of this move, and big money's already started. In fact, I was looking too, I'm glad you're going to bring this next chart up in a second, but I was looking as well as when the bond market, when it bottomed out, and everything seemed to have rotated at the end of April, Phil. When we said about the great rotation, right? So gold has been moving since then, silver's been moving since then, Bitcoin's been moving since then, uranium's been moving since then, et cetera, et cetera, et cetera. And the stock market has really been churning. Even though it's making all-time highs, the rate of change has started to flatline out. And when they make their big move is when they're going to try to put that liquidity injection to work to basically sell the rest of their stock to retail and continue to rotate into the long bond. And the next chart, I'll let you speak to it, but this is a weekly chart that's a ratio chart of the SPX over TLT, if I'm not mistaken. It's still too small for me to see. And I think, Phil, you're going to share with them when you should be like waving the white flag here, and you should be moving strong into bonds and out of the broad markets.
Yeah, first of all, this chart is the SPX against the TLT. So what we're looking for, and what we would say would initiate the recession trade, if you will, is when the SPX falls against TLT being the 20-year bond ETF, right? And it's probably the most traded instrument if you want to be in and out of bonds through your brokerage account. You just trade TLT. When we get into a recession trade, as Bob was mentioning, the big money is going to vacate the S&P 500 stocks, etc. They're going to go into the safety of bonds. And as Bob had it illustrated, you are going to see a twofold reward for that. One is the actual capital gain from the price of the bond, the face value of the bond, right? Plus, if you get in early, like now, before the rate cuts start to happen, you're locking in 4 to 5% APR for the term of those bonds. So, if we're dealing with a recession, you're looking at 2 to 3 to 5 year type bonds, probably the most popular, but it's going to drag along long end of the curve as well. And so you're going to see, as that trade develops, you're going to see the yield curve go to flat and then positive in the steepener. It's going to be a bull steepener, right? Because the bullish demand for bonds is going to steepen the yield curve on the long end, and you're going to get back to a more normalized yield curve. So that's why those things happen as we go into a recession. But it's a very juicy trade if you're doing big money, because again, you're locking in capital gains on the price of the bonds themselves, the face value, and you're locking in, probably more importantly, those APRs, as because the market will come down 10, 20, 30, 40. If it's a severe recession, 50, 60%, right? And your bonds are totally insulated from that. So that's the big trade here. Now, in terms of what we look for, again, we're using the worm on our trade force template here. This is a weekly chart. There's really nothing here to indicate that that trade has begun. In terms of like what we look for, that would signal a recession is underway. But as Bob showed you, the big bets are being placed. And if you guys recall TLT, we said watch TLT under 88. It's been defended very well down at that level. Why? Because that's a big support level and the big boys are in there buying that. So make no mistake, they're building positions now, but where it really starts to like accelerate for them and make money and they can outperform the market is when this chart starts to go. So if you'll notice, we got a red color indication on the background, the lower indicator pane. That's just telling us that momentum is waning, but that's not a trade trigger in and of itself. The actual worm indicator, that green looks like, caterpillar, that's still green. Right? That's saying the trend is still up for the SPX against the TLT. And that's largely because they're trading in tandem. And what we're looking for is a divergent trade where the S&P drops and it's inversely correlated with TLT at that point. So SPX down, TLT up. That's where this chart really rolls over. You're going to see the worm turn yellow and then it's going to go just into a yellow thin line there. And that's when all bets are off. And you're probably dealing with a recession environment at that point. But right now we just don't have it. So the next thing we're going to look for on a weekly basis is that yellow color down below on the worm. And then if we get that white line right under price, that's the vol stop. If we start trading under that on a weekly basis, Bob, sayonara.
Yeah, and if you guys don't believe this, and the Fed also then starts lowering interest rates, this trade happens fast. When this trade starts, you're looking at probably 12 to 14 weeks and the most of your profits out. So they'll move fast, they'll front run this thing hard, and the Fed's going to play catch up trying to catch down to these numbers. So you have to start building your position here, shortly. For us at Trade Genius, we have no official trade on TLT, but we've been building and are owning a TLT and a TLTW position now for quite some time. And we're just, managing the dividends and selling calls against it. But when it becomes official, I'll be doubling up and just sitting back and relax, because why bang your head against the wall? And just remember too, Phil, if you think trading long is hard, trying to trade short this market, it's going to be impossible for most retail people. So you're better off sitting in something like TLT or TLTW and let the market come to you instead of you trying to outwit the guys that are going to be outwitting the day traders. I guarantee you'll be needing air sickness bags after about 2 or 3 weeks of what's going to happen when this market rolls over. So Anyway, guys, that's it. I think, Phil, we have pre-market launch doldrums have begun here. I think today is one of the tightest SPX ranges we've had in months and months. And guys, get used to it. And then sometime beginning middle of March into middle to end of August is going to be probably a slow grind higher. That should be pretty profitable for those who are long. So stay tuned. Thanks, Phil.
Trade Genius.